Silver has crashed 22% from its record high, down 17% in the past 24 hours. $1.1 trillion erased from its market cap, currently trading at $95 on COMEX. Gold is back below 5,000. And here's what makes this absolutely critical. In our previous video, we laid out the exact technical levels to watch. We said the 150-hour EMA would act as support, and initially it did. Price bounced 10% before selling pressure broke that EMA, opening the path to the $90 to $95 support zone we identified. That's exactly where we are now, testing if it holds or breaks to 86. I shared this live on X. If you're not following me there, you're missing real-time charts and data I can't post here. The handle is OGJohnAG on both X and YouTube. It's verified and can't be duplicated, so ignore the fakes. I don't sell anything, no courses, no signals, just unbiased information to empower independent thinking. Your feedback drives this. Comment below with where you're watching from and your price prediction for next week. Now here's the part that should have everyone paying attention. While COMEX silver is trading at $95, Shanghai silver is trading at $136. The Shanghai premium just hit $36. 36. That's the largest premium we've ever seen. Physical silver in China is trading 37% above paper silver in New York. Let me say that again. Physical is 37% premium to paper. The safe haven asset is now trading with crypto-level volatility. Silver smashed $20 from $115 down to $95. Gold erased $4 trillion in 24 hours. Silver erased $1.1 trillion. This is extreme volatility. This is forced liquidation. This is the paper market breaking under the weight of leverage, while the physical market is screaming the exact opposite message. And speaking of the physical market, check these ratios. The gold-silver price ratio just rose to 51 to 1. Gold is trading at 51 times the price of silver. Meanwhile, the mining ratio is 1 to 8. For every 1 ounce of gold mined, 8 ounces of silver are mined. The COMEX vault ratio is 1 to 12. For every ounce of gold in COMEX vaults, there are 12 ounces of silver. The LBMA inventory ratio is 1 to 3. So we're mining silver at 8 times the rate of gold. We're storing it at 12 times the rate in COMEX, and it's trading at 1/51st the price. Does that make sense to anyone? And here's the kicker. The silver vaults are getting drained more by the day. Inventory is declining while the price ratio is expanding. Connect the dots. Now let's talk about what triggered this crash, because the timing is suspicious. Gold and silver prices started to fall at the open of trading in China, according to reports. Then the London Metal Exchange announced it has technical issues and a delayed opening. Silver got smashed $20 from $115 to $95 right as the LME delayed its open. Technical issues, right? The LME delays open and sends silver down the mine shaft. There's not much fundamental news driving this except today's expected FOMC chair pick by Trump. That's the catalyst everyone is watching. If Trump picks a conventional Fed chair, markets might stabilize or continue selling. But if Trump surprises everyone and picks Judy Shelton as Fed chair later today, gold and silver could make a significant intraday rebound, and it would mark the end of decades-long price rigging. Let me explain who Judy Shelton is and why her potential appointment would be a bombshell for the banksters. Shelton is an economist, former Trump Fed nominee, and one of the most vocal advocates for sound money in modern times. Her ideas challenge the very foundation of the fiat financial system. She advocates for a gold standard to curb inflation and debt. She proposes gold bonds to reintroduce sound money gradually. Her ideas challenge the Fed's unlimited money printing power. Under a gold standard, the value of the dollar is tied to a fixed amount of gold. Inflation is controlled because money printing is limited to the gold reserves a country holds. Government debt can't spiral out of control because spending would be restricted by real resources. Monetary stability is restored, giving individuals and businesses confidence in the long-term value of their money. When Trump nominated Shelton to the Federal Reserve in 2020, her candidacy faced intense resistance. Why? Because Shelton's ideas challenged the Fed's ability to print trillions of dollars to bail out banks and inflate financial markets. A gold-backed system would restrict manipulation and force the Fed to act with accountability. Her nomination was blocked by a narrow Senate vote, but her ideas have gained traction. Recently, Shelton proposed gold bonds as a stepping stone toward sound money. The U.S. Treasury could issue bonds denominated in gold, not dollars. Investors could redeem these bonds in gold at maturity, bypassing the risks of fiat currency devaluation. This system would create a parallel market tied to real value, encouraging fiscal responsibility and offering a hedge against inflation. Gold bonds wouldn't replace the dollar immediately, but would lay the foundation for a transition to sound money. If Trump picks Shelton as Fed chair today, it would signal a fundamental shift in monetary policy toward sound money, away from unlimited printing. The implications for gold and silver would be enormous. The paper manipulation machine would face an existential threat. The decades of price suppression through derivatives and concentrated shorts would be under direct policy attack from the Fed itself. That's why today's announcement matters. That's why the timing of this crash is suspicious. That's why silver got hammered right before a potentially game-changing Fed chair pick. The banksters want to make you believe this is the real price of silver. It isn't. A $36 Shanghai premium is telling you the real price. A 51-to-1 gold-silver ratio against an 8-to-1 mining ratio is telling you the real price. Vaults getting drained while paper price crashes is telling you the real price. But here's the part most people are missing. In yesterday's video, we laid out these exact technical levels, and they're playing out precisely as we discussed. The 150-hour EMA held initially with that 10% bounce from 108 to 117. Then it broke. We said if it breaks, we drop to early 90s. We're there now, testing 90 to 95 support. If this level holds, we can move higher. If it breaks, 86 is the next target. The roadmap is unfolding exactly as outlined. But here's what's different this time compared to every other silver crash in history. The physical market is not following the paper market down. Shanghai premium $36. That's unprecedented. In past crashes, premiums would compress or even go negative as physical sellers panicked. Not this time. Premiums are exploding. Physical buyers in Asia are paying 37% over COMEX spot to get metal. They're not scared. They're buying the dip aggressively. They know this paper price is fiction. Shorting won't end the shortages. It will only worsen them. The banksters are digging their own grave here. Every dollar they push the price down, the Shanghai premium expands. Every ounce they short on COMEX, the physical market absorbs and demands delivery. Every raid they conduct, Asian buyers step in harder. They're losing control, and they know it. Now let's address the downside risks, because after a 22% crash, we need to be realistic. We're down from 121 to 95. That's a massive correction. If 90 to 95 support breaks, we could see 86 or lower. The technical damage is real. The momentum has shifted bearish short term. If you're trading on leverage, if you had tight stops, you got stopped out and liquidated. The volatility is too extreme for over-leveraged positions. 1.1 trillion in market cap erased in 24 hours is a liquidation cascade. Margin calls hit, forced selling happens, weak hands panic. That's the reality of trading in this environment. And here's the other risk. If Trump picks a conventional Fed chair instead of Judy Shelton, if there's no policy shift towards sound money, the paper manipulation could continue. The banksters could push silver lower. We could see more technical breakdowns. Lower levels could be tested before we find a real bottom. Bitcoin is also getting crushed down to a 2026 low of 81,200, down 6.3%. Crypto is selling off. Stocks are weak. Gold below 5,000. Everything is getting hit. If this is a broader risk-off move, if liquidity is tightening, precious metals could get dragged lower in the near term, even though they're supposed to be safe havens. But here's why the downside risks, while real for traders in short-term price action, don't change the structural physical market thesis. The $36 Shanghai premium is the largest in history. That's not a sign of weak demand. That's a sign of desperate demand. Physical buyers are willing to pay 37% over paper spot to get actual metal. They're front-running the squeeze. The gold-silver ratio at 51-to-1 against a mining ratio of 1-to-8 is screaming that silver is massively undervalued relative to gold. When this ratio is stretched this far, it historically snaps back violently. Silver outperforms gold on the rebound, and we're at one of the most extreme ratios in modern history. The vaults are getting drained. COMEX inventories are declining. LBMA inventories are under pressure. Shanghai is pulling metal east at a $36 premium. The physical market is tightening while the paper market is crashing. That divergence can't last. One of two things happens. Either COMEX price rises to meet Shanghai, or the COMEX pricing mechanism loses all credibility and Shanghai becomes the price setter. And here's what validates our analysis. In yesterday's video, we called these exact technical levels, and they're playing out step by step. The 150-hour EMA held gave us that 10% bounce to 117, then broke. We said if it breaks, early 90s is next. We're testing 90 to 95 right now. If this support holds, we move higher. If it breaks, 86 is the next level down. The technical roadmap is proving accurate in real time. Either way, the physical fundamentals are screaming shortage while paper is screaming liquidation. So where does this leave us? 3 key takeaways. Number 1, the technical levels from yesterday's video are playing out with precision. 150-hour EMA held initially with a 10% bounce, then broke. Price dropped to early 90s as predicted. Now we're testing 90 to 95 support. If this holds, we move higher. If it breaks, 86 is next. The technical roadmap we laid out is unfolding exactly as discussed. Number 2, the physical paper disconnect just hit an all-time extreme. Shanghai premium $36. Gold-silver ratio 51-to-1 against mining ratio 1-to-8. Vaults draining while price crashes. This is not a broken market. This is paper manipulation meeting unstoppable physical demand. The banksters are shorting into shortages, and it will only worsen the squeeze when it comes. Number 3. Trump's Fed chair pick today could be the catalyst that changes everything. If Judy Shelton is picked, her advocacy for the gold standard and gold bonds represents an existential threat to the paper manipulation machine. If a conventional chair is picked, the battle continues. Either way, watch today's announcement closely. The unresolved question is this: does 90 to 95 support hold or break? If it holds and we bounce, does the Judy Shelton Fed chair pick accelerate the move higher, or do we see more technical damage with a break to 86 before the physical reality finally overwhelms the paper fiction? We're at a critical inflection point. The technical levels we called are being tested right now. The physical market is at maximum divergence from paper, and a potential policy bombshell could drop today that would validate everything the sound money advocates have been saying for decades. Stay sharp. Watch these levels. Watch the Fed announcement. The next move could be historic. Do your own due diligence. Understand the risks. If you're over-leveraged, this volatility will destroy you. If you're building physical and understand what's happening structurally, this could be the shakeout before the real move begins. Time will tell. Invest with logic, not hype. Something extraordinary just occurred in the silver market that challenges everything we thought we knew about price manipulation. This morning, we witnessed a $15 drop in just 30 minutes. Silver plummeted from $121 to $106, representing a 15% decline in half an hour. But here's what's absolutely remarkable. As I'm recording this, silver has not only recovered, but turned positive for the day, currently trading at 117. This isn't typical market behavior. What we're observing is the physical market demonstrating overwhelming strength against traditional paper-based price suppression tactics. The established system is showing serious strain in real time. I'm recording this on January 29, 2026. For those following my analysis, I share live updates and technical charts as they develop on my social media platform. That's where you'll find real-time vault flow data and technical setups that don't make it into longer video formats. If you haven't connected yet, my verified handle is OGJohnAG on both platforms. That's your authentication marker. Unfortunately, impersonator accounts appear regularly. I can't chase down every fake profile, but OGJohnAG is the verifiable protected handle. That's the one authentic identifier they can't replicate. For new viewers, I don't monetize through signals, courses, paid communities, or subscription pressure. This channel provides comprehensive market analysis, clear-minded, hype-free, independent thinking. Many find value in this approach. Your questions enhance my understanding too. Feel free to comment below with any thoughts or simply drop OG John AG so my team and I can identify genuine community engagement. The Shanghai Premium Anomaly. Now here's what makes this situation absolutely unprecedented. According to current Shanghai Futures Exchange data, silver is trading at 31,620 yuan per kilogram. That converts to approximately $141 per ounce. Meanwhile, COMEX shows $116 to $117. The Shanghai silver premium has reached $25 per ounce. $25. Historically, a 15% price smash in 1 hour would trigger cascading stop-loss orders and induce days or weeks of continued selling pressure. Silver's entire upward momentum could be completely derailed by a COMEX paper dump of several billion ounces worth of contracts. That was the traditional mechanism. That mechanism appears broken. Currently, physical demand for silver is so intense and sustained that historic downward price movements are being completely erased within hours, and the uptrend simply continues. Examine today's timeline. 9:15 a.m., silver at $121 per ounce. 10:29 a.m., silver at $106, $4 p.m., silver at $117. We spent 4 years trading between $20 and $30, barely moving 50 cents daily. Now we're experiencing $15 intraday swings. The volatility is absolutely extreme. The critical pattern. Here's the crucial detail you need to understand. Nearly all selling pressure this week occurred during U.S. market hours. The United States sells and dumps digital derivatives and paper contracts, while the rest of the world purchases and accumulates physical metal. That's the pattern. That's the signal. When New York markets are open, paper gets dumped. When Asian markets wake up, physical gets purchased and prices recover. The bullion banks carrying short positions of hundreds of millions of ounces are growing increasingly desperate to extract themselves from their precarious situation. They're now so desperate, they've executed 2 separate $15 raids on silver this week. 2 separate attempts. What's the result? Silver spot prices back above $117. Instead of inducing massive follow-through selling like historically occurred, silver immediately rebounds and recovers the moment COMEX paper dumping completes. Relentless Asian demand from India and China simply won't allow bullion banks to suppress silver prices sufficiently to unwind their massively underwater short positions. The Shanghai silver premium surpassing $25 per ounce signals a monetary regime shift from Western systems to Shanghai. The spread between Shanghai and LBMA COMEX silver prices growing to $5 daily is simply unsustainable. System breakdown sequence. Connect these dots, and the situation worsens for the paper system. Things have already started breaking. First, U.S. refineries experienced lockups. Refineries backed up and stopped accepting metals. The retail market began fracturing midweek as reports emerged that many local coin dealers halted metal purchases due to capital constraints and slow turnaround times. Then, sources within the retail bullion industry reported Thursday afternoon that a major government mint is shutting down silver sales within the next 24 hours. First refineries, then local coin shops, now major government mints. The entire system is fragmenting, and the genuine short squeeze hasn't even commenced yet. Let that register. We haven't reached the squeeze phase. This is merely the prelude. This is just the physical market beginning to assert dominance over paper fiction. Understanding the crash triggers. Let's discuss what triggered this morning's crash because multiple factors converged. First, excessive leverage. Traders accumulated 50x to 100x leverage in futures contracts. When initial selling started, it triggered cascading forced liquidations. Small moves became massive sell-offs as margin calls hit and positions got automatically closed, wiping trillions in paper gains. Second, profit taking. Gold has risen 160% over 2 years. Silver has climbed nearly 380%. These are parabolic moves. People are securing gains, removing capital after runs like that. Third, broader market sell-off. Microsoft dropped 11% today on disappointing cloud and AI growth numbers. Morgan Stanley removed it from their top picks list, dragging NASDAQ and S&P 500 lower, creating a risk-off cascade affecting everything. Fourth, extreme overbought conditions. Gold and silver reach their most overbought levels in history. Markets flush out weak hands when conditions get that extended. It's textbook price action. Fifth, no major catalyst, no policy announcement, no war outbreak, no central bank shock. This was pure technical unwinding and position liquidation. All those factors are genuine, all contributed. But here's the critical reframing. The fact that all 5 bearish factors hit simultaneously. Extreme leverage unwinding, profit taking, equity sell-off, overbought flush, pure technical capitulation, and silver still turned positive the same day reveals everything about underlying physical demand. The paper market deployed everything available, maximum bearish confluence, and it got completely absorbed and reversed within hours. Gold initially dumped 8.2% in 1 hour, erasing $3.1 trillion from its market cap. It then pumped 5.2% and added $1.9 trillion back. A $40 trillion asset is moving like a speculative cryptocurrency. That's how fragile the pricing mechanism has become. That's how much leverage exists in the system. That's how disconnected paper is from physical. What major banks are now saying. Speaking of disconnects, let's examine what major banks are now publicly stating. JP Morgan sees gold surging toward $8,000. Gold could continue rallying as private investors increase allocations from 3% to 4.66% of portfolios, according to JP Morgan's Nikolaos Panagirtsoglou, potentially pushing prices to $8,500 per ounce. Gold recently hit $5,600 amid safe haven demand, central bank buying, and shifts away from long-term bonds. Check the progression. Goldman Sachs, $5,400. Deutsche Bank, $6,000 JP. Morgan, $8,500. Who bids higher? The targets keep getting revised upward because fundamentals keep strengthening and banks are finally acknowledging what the physical market has been signaling for months. We're in a new regime. The old price anchors are gone. Addressing the bearish case. Now let's address the bearish perspective directly because I won't pretend risks don't exist. We just witnessed extreme volatility, $15 intraday swings that can destroy leverage positions in minutes. If you're trading on margin, holding paper contracts, running options or futures with tight stops, this environment is a liquidation machine. Your thesis doesn't matter when margin clerks call. Your long-term conviction is irrelevant when forced selling hits. Over-leverage yourself and moves like this morning will eliminate you before you witness the recovery. JP Morgan themselves noted that while momentum may spark short-term profit-taking, we could see more violent shakeouts. The higher prices go, the more profit-taking opportunities exist. The more leverage builds, the more violent deleveraging events become. Gold shows stronger liquidity and breadth than silver or Bitcoin according to their analysis, which means silver could experience even more extreme percentage moves both upward and downward. Here's the other risk. If equity markets continue selling off, if we see broader risk-off movement, if recession fears escalate, we could see more forced selling in metals as people scramble for cash and liquidity. The correlation between metals and equities during panic moments is real. It occurred in 2008. It occurred in March 2020. It can happen again. Why the structural setup remains intact, but here's why the bearish case, while real for traders in over-leveraged positions, doesn't alter the structural setup for physical holders. Every single data point reinforces the bull case. Shanghai premium, $25 refineries locked up coin shops, halting purchases, major government mints shutting down silver sales. Two $15 raids this week, both completely absorbed and reversed. The physical market is signaling deficit, the paper market is signaling manipulation, and the physical market is winning. The fact that silver turned positive after a 15% crash the same day is unprecedented. That has never happened in this market's history. Never. The banks used to induce weeks of follow-through selling with such moves. Now they can't maintain suppression for a full trading session. Asian demand, Indian demand, Chinese demand, it's relentless. It's overwhelming the paper dumps. The Shanghai premium growing $2 to $5 daily is unsustainable. That spread must close. And it will close one of two ways. Either COMEX prices rise to meet Shanghai, or physical metal stops flowing west and the entire COMEX LBMA pricing system loses legitimacy. We're already seeing early stages with refineries backing up, coin shops halting, and mints shutting down sales. The plumbing is seizing. 3 key takeaways. Where does this leave us? 3 key takeaways. Number 1, the old playbook where COMEX could dump paper and induce weeks of selling is dead. Silver crashed $15 in 30 minutes and turned positive the same day. That's unprecedented. Physical demand from Asia is now powerful enough to overwhelm any paper manipulation attempt within hours. Number 2, the system is breaking in sequence. First, refineries locked up, then local coin shops halted purchases. Now a major government mint is shutting down silver sales within 24 hours. This is the physical market seizing because demand is overwhelming supply, and the $25 Shanghai premium is pulling metal east faster than the West can deliver. The real squeeze hasn't even started yet. Number 3, major banks are revising targets higher in real time. Goldman $5,400, Deutsche $6,000, JP Morgan $8,500 for gold. They're acknowledging the regime change. Private investor allocation increasing from 3% to 4.6 to 6% of portfolios represents massive capital flow that's just beginning, and silver, with its smaller market and industrial deficit, is leveraged to that movement. The unresolved tension. The unresolved tension is this: how long can the Shanghai premium stay at $25 before the entire Western pricing system loses credibility? How many more $15 raids can the banks attempt before realizing they've lost control? What happens to price when the physical squeeze we're seeing in the plumbing actually hits derivative markets and forces mass short covering? We're living through the transition from paper dominance to physical dominance in real time. The moves will be violent both directions. The volatility will be extreme, but the direction is established. Final guidance. Do your own due diligence. Understand the risks. If you're trading on leverage, this environment will destroy you. If you're building physical with a long-term perspective and you understand what's happening structurally, this might just be the shakeout before the real move begins. Invest with logic, not hype.